So buying the dip in the iron ore space, in our view, is still quite dangerous, right? So we would recommend investors stay on the sidelines or sell if you still got stock, if you want to lean that way, because we feel that the iron ore price has still more room to the downside, compared to where it is today. I mean, like I know it's fallen from its peak from 220 to around 160, $150 per ton, but considering where that number is, $150 per ton is still in nosebleed territory compared to its history, right? It is still very high versus long-term assumptions of, let's say, $70 per ton.
All right, so as far as the stocks then are concerned, you feel as though the best has passed, that it was as good as it gets where we saw that iron ore price, and from here, it's all a downward trend.
It's all a downward trend, and in fact, I could probably sort of lean out and actually say we probably won't see $220 per ton for the next decade. I could sort of think that way because there are multiple things happening in China. So obviously, China is experiencing a slowdown. Steel demand has been falling over the last couple of months. But what's going on behind the scenes? There's actually something more inherent. A few months ago, we've seen China help approve its Guinea iron ore development called Simandou. In about 5 years' time, there's going to be iron ore volume coming onto the market, right? But right now, as it is, while peak steel demand was observed a couple of months ago, peak iron ore imports into China happened middle of last year. So how did that happen? So peak iron ore demand happened middle of last year versus peak steel demand last couple of months. Is because over the last year or so, China is actually trying to reduce their dependency on iron ore, right? So iron ore imports is now operating at levels below 2020 levels, but scrap demand is very high. So China is actually importing quite a lot of scrap from overseas markets to replace, obviously, or substitute away iron ore. And on top of scrap, China is actually trying to promote domestic iron ore production. Like I know, Chinese iron ore is lower quality, but they consider it strategically an important asset to actually develop it. So you got the high use of scrap imported from overseas, and you got the higher use of domestic production of iron ore, and they're meant to actually replace its dependency on Australian miners and and so forth. Given that Australian miners, depend so much on Chinese imports.
Yeah, absolutely. Particularly when you talk about the big three, BHP, Rio and Fortescue, and that reliance on China buying their product. But also, when you talk about domestic production for China, they're also obviously trying to source iron ore elsewhere, particularly as far as its investments in Africa are concerned.
Yeah, that's right. So that's definitely the one. Simandou is the big development in Africa, in Guinea. Apparently the quality of the iron ore is just as good as, or even better than the Australian iron ore. So once that comes on, you would expect more iron ore to sort of hit the market. But like I said, that has a long lead time for about 5 years because you have to build all the infrastructure and the ports and so forth. But once that comes on, right, there is no chance iron ore going to hit $220 per ton, right? We're just going through that transition period now for the next few years where they're trying to get that going while reduce their reliance on current imports.
Okay, so just to reiterate then, you're seeing no point in hanging on. What you would recommend to sell even as far as a hold is concerned, because obviously we're seeing some very attractive dividends at the moment.
Yeah, so it's versus where they were a month ago, and given the share price retracement, the dividend yields for all three iron ore companies are actually higher today than they were a month ago. So it may look quite interesting from a dividend yield play, but like, man, I tell you what, like if that iron ore price falls away, that the earnings will fall, and so will those dividends as well. So, it's not a fixed type, fixed revenue type business. Those revenues do move around depending on where that commodity price goes. So, and critically, at the end of the day, if you want to preserve capital, it's all about trying to figure out where iron ore prices would settle. And if you take back and look at its long-term history, $150, $160 per ton, right, is still very high versus history, right? So I think investors, if they want to sort of dabble in iron ore, just wait till it comes back to something more reasonable,
Yep.
something under $100 per ton, let's say. And even that might be too high over the long term, but at least let's not get burned from where you are today, $150 per ton to $100 per ton.